Okay, guys, now for the main session of today, I'm sure why a lot of you are joining us because everybody wants to know what's going on in the world. What does this mean for the housing market? So, joining us today again from Scotiabank, we have Jean-François Perrault, who came all the way from Ottawa to be here today. So, thank you, JF. JF joined Scotiabank in 2015 as a senior vice president and chief economist. He leads a team of economists to support Scotiabank's domestic and international business lines and clients from retail to capital markets, providing Scotiabank senior executives, business lines, and customers with perspectives, insights, and forecasts on economic, financial market, and policy developments. Prior to joining Scotia, JF held prominent roles with the federal government, the Bank of Canada, the International Monetary Fund, and the World Bank. Thank you, JF, and thank you for being here with us.
Well, thank you. So I'll just get right into it. There is a never-ending stream of things to talk about these days, and they all hinge around, well, not all, to a very significant degree, hinge around what President Trump is saying or doing. And that's been true for much of the last year. And it's been true in an American context, it's been true in a European context, it's been true in a Canadian context. And unfortunately, most of what that truth is has been, a little bit of a challenge for how people approach major decisions in their lives. And that is absolutely true for Canadians, absolutely true for home buyers, absolutely true for businesses in Canada, in the US, and elsewhere around the world. So we'll kind of talk you through that a little bit, and of course also talk about some of the big drivers of what we believe to be, the Canadian economy, and some of the changes that are underway, and some of the extremely recent policy changes, which I think are going to have a quite significant impact on the Ontario, at least, a market for the time being, and we'll see if that's rolled out elsewhere around the world. Around the country. So, let's start with like the elephant in the room, which is the war in Iran and how that's affecting how we think about things. It is a very difficult situation, obviously, for those that are involved in the conflict and those that are, prosecuting and being subject to the war. It is a major event for the world economy. It's, as I'm sure some of you may know, Iran is a major oil producer. That region is an extremely large oil producer. About 20% of the world's oil flows through the Straits of Hormuz, which Iran is effectively closed now. So, of course, there are consequences from the war itself, but the fact that that channel is largely closed to traffic, to maritime traffic, impacts oil. It impacts commodities. So it impacts, helium, fertilizer, plastics. It's impacting a broad range of inputs, such that it is leading to a very significant increase in concerns about inflationary dynamics. Now, you may ask what that has to do with Canada, and I'll get to that. But the important element here is that concern about the inflationary dynamics. What does oil prices mean for inflation? What does it mean for the cost of doing business? What does it mean for household purchasing power across the world? That increase in inflation, expected increase in inflation, is a major concern for central banks. And if central banks are concerned about inflation and they do something about inflation, well, guess what? Borrowing costs rise. And not only in the short run, but in the longer run. So we've seen since the beginning of the war, and it's only 4 weeks old now, a little bit more than 4 weeks old, we've seen a very significant increase in longer-term borrowing costs across the curve, across the world. 40, 50, 60, 70 basis points higher in the 5-year space, 10-year space, depending which country you're in, as markets digest what it means for, policy, for inflation as it relates to this Iran war. It's leading to a repricing in the short run as well of what central banks are expected to do. And I'll get to Canada in a bit. But in Europe now, markets are expecting, 50 basis points of increases by the central bank in Europe, maybe same thing in the UK. Whereas the market was expecting, 50, 75 basis points of cuts in the US this year. We're now in a world where markets are pricing, either no move, depending on the day, a little bit of an increase, a little bit of a cut. And that is a substantial change in the policy expectations for the US, which, of course, again, determine borrowing costs in a very significant way. The challenge with all this is that we don't know when the war is going to end. The President Trump had a speech last night where he, muddied the water, as he has done very well so far in this space. Is it almost over? Is it not almost over? Do they care about Hormuz? Do they not care about Hormuz? Does he want to leave soon? Does he not want to leave soon? Is he going to amplify the conflict? Is he going to send troops on the ground there? The story changes daily, sometimes hourly on that front. But the reason we think about that so much and talk about that so much is the longer the interruption to commerce in the Strait of Hormuz is, the higher oil prices are going to go. Right now, oil prices, say WTI, actually up right now as we're talking, is up like $10 or $12 today to like 110, 112 bucks because of what President Trump said last night, which was, basically a message of, we're going to keep bombing them for the next 2-3 weeks. We're going to send them back to the Stone Ages. Even though I don't care about the Strait of Hormuz. That message was interpreted for now as an indication that the Americans are going to ramp up the conflict as opposed to de-escalate, which is what Trump had been saying for the last few days. So it changed the message there. And the longer it lasts, as I said, the more that interruption is meaningful. So to give you a sense, I said about 20% of the world's oil flows through there. That's about 15 million barrels a day. We are in a world where there's about 250 million barrels of oil that are no longer in the market because of this. That supply interruption, is probably consistent with an oil price more in the $150 or $200 range rather than the $100, $110 range. So markets are still hoping, expecting that this conflict ends sooner rather than later and that production resumes. And that is reflected in the pricing that we're seeing. So as expensive as it is now, the longer this lasts, the more markets have to come to term with the possibility that we're in the $150, $200 range. And that, of course, is even more inflationary than what we're seeing now. A big concern. So we pay a lot of attention to what the president says about the war. We pay a lot of attention to what the Iranians say about their willingness to negotiate, how serious they are about the closure and all these kinds of things. Because absent a good understanding of where this is going to go, it's very difficult to have a good understanding of what's going to happen to oil prices, very difficult to have a good understanding of what's going to happen to interest rates. And of course, what happens to interest rates determines a broad range of things other than just oil prices. Now, in the Canadian context, there is, a little bit of a silver lining to this. Maybe not for the housing sector, but in general. So most countries in the world import oil. Most countries in the world are net energy importers, net commodity importers. Canada is not one of those countries. Canada is a country where we benefit when oil prices rise. We benefit when the price of fertilizer goes up. We benefit when the price of wheat goes up. We benefit when the price of aluminum goes up, which are all things that have increased significantly in the last few weeks. So there is this challenge in the Canadian context of there are parts of the economy that are going to benefit a lot from what's going on. There is no question about that. We saw this in the Ukraine conflict. Parts of the economy benefited quite substantially from the run-up in commodity prices that resulted from that conflict in 2022. Of course, not everybody benefits from these things, right? So, while we may be revising upwards a little bit our forecast for Canadian growth because of this war, the reality is for Ontarians and folks in Quebec and folks in BC to a significant degree are going to be faced with, less of a boom in jobs because oil prices are going up and commodity prices are going up, more of a hit to their pocketbook. So you have a bit of a regional shift in economic activity that's going to occur. Stronger Alberta, stronger commodity producing provinces, weaker probably Ontario, Quebec, and BC. At the margin, but still weaker. In fact, when we look at oil price shocks and commodity price shocks historically in Canada, there has never been an oil price shock in Canada that has not seen the unemployment rate decline nationally. Doesn't mean it declined everywhere, but it's declined nationally. And that's a really big difference. When we think about Canada and the impact of oil prices and all these things, it's a really big differentiator compared to Europe and even to some extent the US. Higher oil prices, higher commodity prices generally lift economic activity here. What they also do, unquestionably, is they raise inflation. As I said, markets are repricing that globally very, very effectively. There's a question of how much more that gets repriced. But in Canada, we are, and we have been of the view, and those of you that heard me speak in the last, I don't know, half a year, will know that we have been thinking for quite a while that as this year progressed in Canada, that we thought the Bank of Canada would be needing to raise rates a little bit. They cut interest rates 50 basis points last year, second half of last year. We thought, and we continue to think, that is going to reverse in the second part of this year. And that was really a concern related to inflation. So this is before the war. Related to inflation in that, wage growth in Canada is still pretty strong. Actually, the unemployment rates have been generally declining in Canada the last several months. Recent exception being last month. Wage growth has been strong. Productivity growth is still weak. When we look at input costs, input prices, again, even before the war, raw material prices in Canada are rising pretty significantly. We know that's an inflationary consequence. So we thought for quite a while that even though growth was weakish and expected it to be weak in the first part of this year, that the Bank of Canada would likely need to raise interest rates in the second half of this year. The conflict in Iran only strengthens that argument. In fact, we are now in a situation where markets expect the Bank of Canada to raise interest rates twice before the end of the year. And that amount of rate increases is absolutely a function of how long we think this conflict is going to last. If it lasts another month or so, another 2 months, then almost certainly you're looking at more rate increases than two. And that's very simply because of the inflationary consequence of this war. The governor of the Bank of Canada has made it very clear that he expects inflation to be higher. The challenge for central banks in an environment like this, and it's not an easy one for them to manage, because in most countries you have lower growth and higher inflation. You got to pick between which of those things you're going to try and control. And most central banks have to control inflation. So it's a shock that typically requires higher interest rates. And the governor said, listen, I know inflation is going to go up. I'm probably going to look through the original oil price shock. So if oil prices go up and inflation rises, I'm going to try and look through that, but I'm not going to look through any evidence that shock in oil prices is broadening out in the economy. So what we call second round effects. If people start to anticipate that inflation is going to be high, if food prices rise because oil prices are rising, if the price of goods and services rises because oil prices are rising. And reminder, it's not just oil that's rising in this context. Aluminum prices have gone up, 10%. Potash prices, canola prices, wheat prices, plastics prices, a broad range of prices are rising because of this conflict. That the more there is evidence to him that there's a kind of a broadening of inflationary pressures that result outside of oil, he's made it clear that he's going to react to that. And the lesson here being that they didn't do this in the Ukraine conflict. So when Ukraine happened, we had a spike in commodity prices, roughly equivalent to what we're seeing now. Central banks at the time, the Bank of Canada as well, said, listen, we're going to look through this. This looks to us like a temporary supply shock. Prices are going to come down. We're not worried about the inflationary consequence of that. And that was a big mistake because inflation rose and it stayed there for a while. People started expecting higher inflation. It became very difficult for them to control. So they actually had to raise interest rates very significantly to bring inflation down. So we think they've learned from that mistake and they're going to be much more agile, much more rapid in trying to control inflationary shocks such as this one, given the experience of the post-pandemic period and the war in Ukraine. So we are thinking, and we continue to think, that as the year progresses, we're dealing in an environment where rates are going to go up, both short-term and longer-term, because of inflation, because of policy at the same time. So if you're thinking about buying, if your clients are thinking about renewing their mortgage or buying a place, and we've been saying this for many, many months now. Again, if you've heard me speak, you've heard me say this for many, many, many months. Honestly, we think the longer you wait, the more expensive your mortgage is going to be. And that's just a reality of the situation. Now, we didn't anticipate the war in Iran. The war in Iran only makes that more powerful an argument. We think the Bank of Canada raises, we now actually think they raise 75 basis points between now and the end of the year, probably more second half of the year issue. So there's a bit of run room between now and then. We think 5-year borrowing costs rise, 20, 30 basis points from where they are now. Same on the 10-year side. And that is a function of, largely a reaction to the war in Iran. So again, if you're thinking about advising your clients, if you're thinking about the best deal possible for them, there is, in our mind, a very strong argument to move sooner rather than later on that front. And that argument is stronger now than it was a couple months ago, and certainly 6 months ago when we first started making it. Now, we're not obviously the only bank out there that does interest rates forecasts, and I think at this point most of the other banks don't think rates are going to go up this year. That's possible. Depends on the duration of this Iran war. Depends on how inflationary this whole thing is. Depends on how weak economic activity might be, if there is a weakness in economic activity that comes from this. But virtually nobody's talking about cutting interest rates. So, the choice is between, say, rates stay where they are between now and the end of the year as one bound, and rates go up between now and the end of the year. So, in either scenario, the sooner you move, the better, the cheaper the cost of financing is going to be. Now, sure, some organizations might have sales here and there, and there are those dynamics that occur. I'm thinking of it purely from a macroeconomic perspective. So what does it mean for the housing market? Well, there's a couple of really important things that are going on in addition to that. One is population growth, which sucks. We've had a population decline in Canada last year, significant population decline in Ontario, something like 120,000 fewer people in Ontario last year, say December of last year relative to December of 2024. That is entirely a function of government policy, which has cracked down on non-permanent residents, which has led to a much more rapid pace of those people leaving the country than anybody's expected. Put downward pressure on rents, as I'm sure you've seen. It's put some pressure on the condo market, which I know you've seen. So there's a question there as to, what happens to population going forward. Is that going to be a source of strength for the housing market or a continued source of weakness for the housing market? Well, given that we think the population adjustment is what we know was an explicit change by the government. We've gone through 3 years of population growth in the 3% range, created a tremendous amount of pressure on the housing market. Those who were in the market did very, very, very well during that period of time. Created a lot of political pressure, so there was this kind of overcorrection on the population side, which we don't think they're going to undercorrect this year. That is to say, we don't think population policy changes this year very much. So probably flat population growth this year. That's true in Toronto, it's true in Ontario, it's true in the rest of the country. Now, there might be some shifts in population from one part of the country to the other. We saw, for instance, Alberta continue to draw people in. But by and large, this is a world where government policy is dictating what's going to happen on the population side, and there's little reason to believe that you're going to see a reversal in those population dynamics in 2026. When we get into 2027 and beyond, it's a different story. Now, we think immigration has been a political tool to manage over the last, say, 12 months or so. We think the economic imperatives of the country require many more people in the country. That's what we hear from our business clients. There are still significant labor shortages in various parts of the country. And we anticipate that as we get into 2027, the government will think a little bit more intelligently about population growth and allow more inflows of population into the country. So maybe like population growth of 1% or so in 2027. So what we're seeing on the population side is a bit of a temporary lull. Now, it's a meaningful lull because it has implications for the housing market, of course, has implications for the economy. You've got less buyers of homes, you also got less buyers of cars and restaurants and all these kinds of things. So it is a meaningful drag, but we think from a dynamic perspective, much of the adjustment is done. Right? You're talking about kind of a flat environment, maybe for the year, so less downward pressure coming from that, just more stability relative to the path that we've seen over the last year. So we don't think population dynamics are going to be a significant put significant downward pressure on the market this year. They're going to put upward pressure, but not much of a downward pressure. At least that's our hope. What we know has also been a significant driver of market activity in Ontario in particular was I think a good intention on the part of the federal government and on the Ontario government over the course of last year, which was to eliminate or tell people they're going to eliminate the HST on new homes. Now, first it was eliminate the HST on homes on a certain amount for new first-time home buyers. That's changed. But the message was that, those taxes are going to come off at some point in time. So you had buyers out there who might have thought about buying a place last year, a new place, who were listening to, say, Ford, telling them that he was going to put in place, he was going to eliminate the HST at some point in time. And those folks would have said, well, why the hell would I buy a house in June or July or September, October, when Ford keeps telling me that we're going to eliminate the HST on new homes? So you had a challenging situation as a result of that. People who we know wanted to buy places who were just being smart and said, listen, I'm going to wait, because if I wait until this policy is put in place, like, I'm going to save 13% on my house, on my new build. That had very significant implications, not only for the housing market, but for the developing side of things, for prices on new builds and new condos, of course, because people are just like, why would I buy now instead of a few months from now, whenever this policy gets rolled into place? So that uncertainty is now lifted. That tax cut is in effect. Actually, we're April 1st now. It's April 2nd. It is in effect. And it's a big deal, right? It's a big deal because it's got, obviously, it's a 13% rebate on the price of a house under 1.5 million, up to a maximum of $130,000. It is time bound. So in principle, for now, they're saying if you buy the house next 12 months, you get the rebate. If you wait, 12 months in a day, you don't get it. So you're really creating a lot of pressure for people to go into the market and buy places as soon as they can. So we think that's an extremely powerful driver, or will be an extremely powerful driver of activity, because you've got that. And this is an Ontario thing, of course. You've got the rush to get in over the next 12 months to buy a new place, buy a condo that hasn't been sold yet, a new condo hasn't been sold yet, and God knows there are a ton of those, in an environment where we also anticipate interest will rise over the course of the year. So our thinking is over the next few months that we expect a fairly significant rebound in activity. And this is kind of a late breaking thing. We weren't building in a rebound in activity until we knew what the HST policy is going to be. And now we know. Now you've got to set that against, as much of a no-brainer as that seems to be, this HST rebate stuff. You got to set that against, of course, the uncertainty that exists out there because of the war in Iran. The reality is that this is, as much as, we may say this is, probably good on balance for the Canadian economy, the reality is that people are like, well, I'm going to pay more for gas. I don't like that. I don't know how bad this is going to get. Is there going to be a recession? People talk about a global recession. Is it going to impact me? Is this the right time for me to make a major purchase? That will be a concern, folks. I mean, it was a concern over the course of last year with respect to the tariffs and how that impact Canada. This is another layer of that uncertainty. We think the HST measure in Ontario and how it's being phased in, you got 12 months to take advantage of this, like a super sale on housing. And of course, coming off significant housing price cuts, again, in Ontario more than anywhere else, this is a pretty darn advantageous time to get into the market. We think that kind of outweighs things, because we know there's pent up demand for housing. We know there are people that have been buying stuff. They've been waiting for the right time. And it's hard to see kind of stars lining up better than they are now. Now, it doesn't mean that things are going to turn around next week or 2 weeks from now, but it is really, don't underestimate how powerful something like this is. So this effect of the tax rebate plus, at least we think of it this way, an expectation that mortgage rates are probably going to drift upwards over the course of the year. So again, the sooner you get in, the sooner you lock things in, the better. So it's a tricky time to make forecasts. It's a tricky time to advise clients because there's just so much uncertainty out there. I talked about the Iran stuff. Well, 5 weeks ago, we were talking about other stuff. It was tariffs. It was review of CUSMA. So there's a lot of questions about that. Is there is we are reviewing CUSMA with the Americans right now. It's supposed to be a July 1st deadline for that review. There was a fear in some part of the Canadian economy, the Canadian population, that Trump being Trump is going to, and this again, we were talking about this a month ago, that Trump is going to kind of rip up the deal because he's not happy with Canada. He's not happy with, non-Americans basically at this point. And of course, if we're in a world where NAFTA is ripped up or CUSMA is ripped up, then you're talking about a world where there's much more uncertainty, again, possibility of recession, those kinds of things. We have, for much of the last year, argued that this CUSMA review was not really a significant thing. That over the course of the last year, the President Trump has made it very clear through his actions, not through his words, but through his actions, that the trade deal with Canada and Mexico, for that matter, is of sufficient importance to them that he's excluded about 90% of the things that Canada sends to the U.S. through the free trade deal. And we're the only country where that's happened. In fact, over the last year, Canada's tariff advantage in the U.S. has increased dramatically compared to other countries because the president has decided to carve out all those things. I didn't carve him out of the goodness of his own heart. It's not because he's got a soft spot for us. He carved them out because including them, putting tariffs on those things of 25%, 35% would have been very damaging to the U.S. economy. So this is kind of a self-preservation move on his part. And that dynamic is still there. He's proven that he actually needs the agreement. He's gonna huff and puff and say all kinds of things about how bad Canada is, how bad Mexico is, how bad everybody is. I mean, that's his nature. He's gonna try to scare us into submission. But the reality is, and we call this in economics, we call this revealed preference. He's revealed a preference for the deal largely as it stands. So we don't think CUSMA-related uncertainty is going to be a major driver of Canadian sentiment as we go forward in the year. We don't think it's going to lead to very significantly different economic outcomes than what we're currently facing. And we don't think it's going to be a drag on the Canadian economy. That being said, and this is important as you talk to your clients about this, to the extent that they're, concerned about making major decisions, it is absolutely clear that the president will say a whole bunch of horrible things about Canada and a whole bunch of things about the trade deal in an attempt, again, to influence us. But we think that's just going to be the usual Trump talk these days. Because that is another thing that we've learned over last year. And again, even with the war in Iran, that most of what the president says when it comes to the US, when it comes to Canada, when it comes to other countries, he doesn't do anything about. Some recent proof points, again, coming back just before the Iran war, the president said that there was a court ruling in the US that invalidated a series of tariffs that the US had imposed on the rest of the world, including Canada. Called the IEEPA tariffs. The Supreme Court ruled against the president. The president was really upset. Immediately said that I'm going to replace those with 10% tariffs on stuff, which actually was a pretty good deal for everybody. He realized it was a good deal for everybody, and then 24 hours later said, you know what, no, forget that, not 10%, I'm going to do 15%. It's been 6 or 7 weeks since that happened, and the tariffs are set at 10%, not 15%. He threatened additional tariffs on Canada late last year after the Ford ads in the U.S., the Premier Ford ad in the U.S., said, I'm going to put another tariff of 10% on Canada as a result of that. He didn't do that. So he threatens a lot. And markets have largely gotten to a point, and Canadian businesses have largely gotten to a point where you're like, okay, you know what? It's just background noise. If something happens, if he does something that's meaningful, we'll deal with it. We'll reflect, we'll react, we'll change the way we do things. But you can't react to everything that he says. And that's actually been one of the reasons the Canadian economy has been as resilient as it's been over the last 12 months. We've managed tariffs, but despite all the noise, Canadians have been pretty good at tuning them out for the last 6 or 7 months and have gone on with their business. Now, there's a pickup in the housing market in the second half of last year that reflected that to some extent. It's obviously come off since then. There's a big weather element to what's happened the last couple of months. When we look at auto sales, which are really a pretty good indicator of how consumers think about things, auto sales the second half of last year, and even into this year, we don't have March auto sales yet. We've got February auto sales and January auto sales, extremely strong and strengthening through the second half of last year. Consumers are like, you know what? We're tuning them out. And, wage gains are good. In fact, second half last year saw pretty strong job growth as well. Bit of a different story so far this year, but again, there's some weather stuff there. So households were kind of getting back into the rhythm of things. And in fact, when we think about households, we look to the indicators that we have available to us now. Again, big job decline in February. We think big part of that was weather, but not exclusively weather. You'll remember places like Toronto where, like I forget, 67 meters of snow shut down the city for a couple of days. That happened to a few other parts in the country, and that, of course, impacts job growth in that particular month. But when we look at things like retail sales, so not only have car sales been strong, we look at retail sales. Retail sales in the first quarter in Canada are tracking something like 7% growth, which is really strong. Now, this is before the war. And this is at a time where the president was extremely active in terms of saying things. He's like, you know what? We're tuning that out. So as you talk to your clients, as you counsel them, as you advise them on rates and what the right thing to do is, keep that in the back of your mind, that as much as Trump is going to say stuff that may influence their decision making, that may scare them, that may want them to delay things, remind them that much of what he says is not true. Well, obviously not true, but much of what he says, most of what he says, he doesn't follow through on. And that's, once you're kind of in that frame of mind, it's a bit liberating, because then you see things for, the underlying economic reality. Because as we then think about that underlying economic reality, like what kind of world are we going to be in, say, the second half of this year into 2027, even and beyond. So if you're thinking about investing for the longer run, then the picture becomes a lot brighter. Because not only are we past the tariff stuff, hopefully we're past the Iran stuff, but again, Iran is probably positive for Canada by and large. You get into the transformation stuff, the Prime Minister Carney working with the provinces, trying to strengthen the Canadian economy, raise investment. They've done a lot of stuff on that so far. Of course, nothing's really paying off in the short run because investment takes a while to turn around. But as we think about second half of this year, as we think about 2027, we are expecting investment to pick up meaningfully and probably see significantly stronger growth in the second half of 2026 versus first half of 2026, and much stronger growth in 2027 than 2026 as the momentum builds around, the investment agenda, the productivity agenda, as foreign investors think about this differently, as the world becomes hopefully more and more certain or less and less uncertain. And that's also a pretty positive thing as we think about that. Just, we're not sure how to price that in yet, and we're not really pricing that into our forecast in any meaningful way. But there's a possibility here that if the PM gets what he wants, which is $1 trillion more of investment over the next 5 years relative to the path that we've been on, to give you a sense of that, we're investing about $500 billion a year in Canada now. So an extra $1 trillion over 5 years is $200 billion a year. It's a tremendous amount of money if that actually works. We're doubtful. But that is kind of a game changer scenario. So as you think then about not just the short run in terms of like, when's the right time to buy, what are my financing costs, do I have the confidence that, the economy I'm buying into now will be better than the economy I might be selling into 2 years from now, 3 years from now, 5 years from now, like whatever your horizon is, if you want to sell. It's almost certain in our mind that we are looking at a world where things are going to be better by the time we kind of get to that part of the recovery of the plan, to the extent that it is a plan. So I think I can kind of just start there. Like that's about a half an hour to set the stage a little bit. I touched on a broad range of things. There's a bunch of stuff I haven't talked about. I'm happy to talk about those. I think there's you put stuff in the chat. I'm not sure how that works exactly, and I will get asked questions.
Yes. Thank you so much, JF. We're gonna give JF 60 seconds here to get a sip of water. I do see there's There's a bunch of questions already in the chat, guys. If you have any questions, now's the time. Put them in there. We're going to get started in about 1 minute. That was a lot of information, and now's the time to ask questions. Don't be shy, and we'll start in a minute here.
Trust. It's the foundation of every decision you make. And at Fides, it's what we build on.
Because finding the right mortgage isn't just about numbers.
It's about your story, your future.
At Fides Mortgages, you're not just another client.
You become family, and family deserves more. More clarity, more confidence, more care. From the first conversation to the final signature, we're with you every step of the way.
You'll never wonder what's happening or feel unsure of your next move.
Because we make it simple.
With Fides, you're backed by a team that listens,
Understands,
and delivers.
We're not just your mortgage broker.
We're your guide, your partner, your safety net.
Like the elephant in our logo, strong, loyal,
And steady. We lead with purpose. We never forget what matters most.
You. Fides means faith.
and that's exactly what we bring in every relationship. Faith in your goals.
Faith in your dreams. Whether you're a first-time home buyer,
Refinancing.
or planning your next investment.
we eliminate the guesswork so you can move forward with confidence. And as part of our herd, you'll always know you're in the right place with the right people. Join the herd. Join the herd.
Join the herd.
Join the herd.
Join the herd.
Join the herd. Join the herd.
Join the herd.
Join the herd.
The Fides is born to change how the industry works for our consumers and the mortgage agents. Let's talk about how it's going to change the consumers. This business is based on trust, honesty, and integrity, and that's a value I believe in, and that's a value that my team builds in as well. The whole point of Fides is to give the honest advice with a speedy and a best customer service to our business partners and to our clients. They will never able to doubt the decision they made about their home financing in their life. What's going on in the industry is there's a lot of business owners putting their best interest before the client's best interest. It's impacting and it's breaking a lot of families financially. That's leading to a lot of issues, including health and family issues as well. So we are crafting the team who has the same values that can take it down top to the bottom to be consistent with our values from Fides. We have a system in place, and we have a technology in place, and we have people in place with the experience to give the white glove service and a speedy service to our clients and our business partners. We work with the top tier banks, including Bank of Nova Scotia, TD Bank, BMO, and many other alternate lenders, private lenders, and commercial lenders in our space to give the best service for our business partners and our consumers. Fides mean God of trust. As any consumers, when they make the phone call or when they reach out.
Awesome. Thanks, everybody, for bearing with us. So we're going to get into the questions. Jeff just delivered a jam-packed, informative session. So there's a lot of great questions here. So we're going to start, Jeff. The first question that we have for you is around oil prices. That you had mentioned that oil prices in the past, increasing oil prices, in the past, have typically led to unemployment. But it seems this time around is a little bit different. What is your take on that?
Yeah, so just to clarify, so historically in Canada, when oil prices go up, the unemployment rate goes down. There was a question as to whether that's the case now. There is a little bit of a difference when you think about oil prices as coming from a supply shock or demand shock. And so just to be a little bit clear on that, when global growth picks up and then people need more oil, and oil prices go up because of that, that is unquestionably positive for everybody, right? Because oil prices are responding to something positive. When oil prices are going up because there's a supply shock, so part of the global economy is like impacting the supply of oil and prices go up because of that, that can be different. So this is clearly an environment where it's the supply issue is happening, right? You can't get oil through the Strait of Hormuz. That's a supply issue. It's very bad for the rest of the world. So there is the question that we've got. As I said, we're raising our forecast just a little bit because of these oil price shocks. Historically, a $10 oil price shock in Canada would lead to about a 0.5 percentage point increase in GDP. So these are big things. And we've got like a $40 oil price shock right now. In principle, going by history, that would add 2 percentage points to GDP over the next couple of years. Like, we're not doing that. And we're not doing that because the nature of the shock, again, there's a supply dimension to it. Equity markets are responding very negatively to all this stuff, as they should. And the global economy is very negatively impacted by all these things. So as much as, oil is good for us and aluminum prices are good for us, the reality is that we export to the rest of the world. And if the rest of the world's in a horrible spot, we're not going to be in a great spot. So there is a possibility that unemployment rates increase a little bit in Canada as a result of this, in contrast to history. We don't think that's going to happen, but that's possible. What is more likely is that we get a decline in the national unemployment rate because of these oil price shocks and commodity price shocks. Say, things look much better in Alberta, maybe Saskatchewan, Newfoundland, some of these commodity producing provinces, at the expense a little bit of, say, a higher unemployment rate, maybe in Ontario, Quebec, and BC. We'll see how that plays out. Right now, we're not banking on big increase in unemployment rate in Ontario, but again, that depends on the duration of this bloody thing. It depends on how bad the rest of the world ends up being if there is no end in sight to this conflict.
Okay. And now, if we switch over to the housing market, JF, I think a lot of people want to hear from you about this. What's your take on kind of where we're at in the market? Do you think that we've kind of hit the bottom? Do you think that there is still some more bottoming out to happen? And can you relay that specifically to major markets like Ontario and BC here in Canada?
I think if you're not at the bottom now, you're going to be at the bottom very soon, right? You can't this is more of an Ontario issue than a BC issue at this point in time, given the tax change in Ontario. But listen, again, we know people, I'm sure your clients have been sitting on the sidelines waiting for some of these things to happen, and they're happening. I don't know how many, 7 or 8, I forget the number of unsold condos in Toronto right now, which are putting prices down, keep putting downward pressure on prices. But as soon as people start to pick up on those, because all of a sudden those things are 13% cheaper than they were, that's going to draw people in. So we think the market is very close to bottom right now. Yeah, it might last another month or two. I'm not sure. But for somebody who's saying, listen, I'm going to stay out of the market another 3-4 months because I think prices are going to go down 5 or 10%, I'd say you're taking a really big chance. Because the other impact here is that, and this is a market psychology thing, as people get back into the market, and there isn't a ton of supply out there. I mean, fine, there's some leftover new condos and things here and there, and there's some resales out there as well. But there isn't a ton of supply out there. And as sentiment changes, and if you get people getting into the market to take advantage of, say, this one-time sale, it doesn't take a whole lot to send prices going in the other direction pretty quickly. That's how we think about it in the short run. We think about that even more in the longer run as we think about, housing starts and how low they've been, completions, how low they've been. We know there is still a fundamental unmet demand in Canada that's in the multiple millions of units. Now, again, market conditions are clouding that for the moment, but as the market kind of starts to rehabilitate itself, we expect prices to rise, probably significantly the next 2-3 years, even though population growth is not going to be what we've seen in the last number of years. On the BC side, it's a little bit of the same thing. I mean, the federal HST is off. The federal GST portion of that is the federal portion of HST is off. We've been waiting for that, so it's good news. The BC market was a little bit stronger than the Ontario market in the first place, and the resale market's stronger in BC than it is here. And again, we expect that to gradually shift, but we expect a more imminent shift in Ontario just because of the nature of the HST change, which is dramatic.
It seems like everybody thinks that they can time the market and everyone wants to be able to do that, right? But what I find too, it's like the people that are sitting on the sidelines and waiting to make that purchase, once they have that switch, it's almost like everybody else does too, and they all get off the bus at the same time. And that's where we see more, that FOMO, right? And it puts that undue pressure on the market. Yep. So you can't time the market. Remind your clients of that. Okay. And now in terms of during your presentation, you talked a little bit about kind of where, thoughts on interest rates were, where we thought they were going to stay, maybe even go down. And now you kind of have two sides to that, where you have some, economists and banks thinking that rates will probably stay kind of pretty consistent. Others thinking that we could see up to 75 bips increase. Mm-hmm. What is your thoughts on kind of where interest rates will go?
Yeah. So we're in the camp of those who think rates are going to go up. So we've got 75 basis points of tightening in Canada this year, Bank of Canada, and then no more after that. But that's assuming, again, that oil prices don't go much higher than where they are now, and they start to come down in the not too distant future. If we're in a world where that's not happening, oil goes up to 150 or 200, God forbid, that the price of all these other commodities keeps going up. then you're in a world where you're not talking about 75 basis points of heights anymore. You're talking about 75 plus, maybe more rapid, maybe some 50 basis point increases at some point in time. That's not what we're forecasting, but the reality is that, again, the situation they're on is so unstable, it's so difficult to game out, that any significant further increase in prices of oils puts you in a world where you've got to think about rates differently, like even more tightening than what the market might have in mind or what folks like us have in mind. This would be true at the short end for the Bank of Canada, and it's true, say, in the 5 or 10 year space, 3-year space, depending on how you want to finance yourself.
Awesome. Thank you so much. Okay. Another question here, Jeff, and it's related to the foreign buyer ban. So do you think the expiry on the foreign buyer ban in Jan 27th, along with the uncertainty in the UAE, will increase the housing demand in Canada?
I think so. I mean, the question on the foreign buyer ban is whether or not it stays in place or not. I very much hope it doesn't, but that's a political issue. I think if the foreign buyer ban were not present now, we'd have a different condo situation across the country and different development situation across the country. We've always thought that. In an environment of uncertainty like this, where big parts of the world are being impacted in a very significant way, and in particular in a way that actually is meaningful to people's livelihoods, right? Like you're getting bombed out of your house. You're like, I moved to this part of the world that was going to be safe. It's no longer safe. I got to find somewhere else. We would expect some of those folks that are there. In fact, we know there's a movement out of Dubai right now to go back to other parts of the world. Now, Canada would probably be one of those countries. Are you talking about enough of a flow for that to have a meaningful difference? Probably not. Or maybe in some high-end parts of the market in some parts of the country. But the foreign buyer ban, I think, would be different. If that were to change, and we hope it does, then you're looking at a world where not only, and this is a perverse impact actually, not only would you not see further price appreciation in the shorter run, but maybe you get less price appreciation pressure over a longer run because you got more people going in helping finance new construction, that then increases supply and reduces the supply-demand imbalance over a longer period of time.
Okay. Now, Jeff, in respect to kind of the housing market, again, going back to that, can we talk a little bit about condos? I think we've seen, a big shift and kind of the biggest drop, I would say, in the condo market. What is your outlook on, both the pre-con condo market along with the resale condo market in the coming months?
I think we are in a world now where we're not really thinking about condos differently than new homes, than single family homes. I mean, obviously the story is very different over last year, but I think we've gotten to a point where the trigger's been reached, where condo prices have come down enough, house prices have come down enough. Again, rates more likely to go up rather than down over the next little while. And again, that HST thing, a huge deal and probably a bigger deal for condos than it is for single family homes at this point. So we'd expect in the next few weeks, maybe even this week, a significantly more interest in the condo space in the GTA, in Toronto, obviously, or Ontario, but GTA particularly, than we've seen in quite a long time, just because there is, there aren't, some folks will say there are a lot of places for sale or a lot of places available. There are not a lot of places available if people actually start to show up and want to buy stuff. So there is actually a bit of a rush. If you want to get in the condo space, you don't have a whole lot of time before what's there is evaporated, and then you got to wait for a year or 2 or 3 or 4 or 5 to get your place if you buy it a pre-con right now.
Jeff, thank you so much for being here today. Thank you for sharing your insights with us, coming all the way to from Ottawa to spend the morning with us and to talk to our listeners on the call. Thank you, everyone, for joining us today. I want to pass it over to Varun just to say a quick few words to end off today's session, but we truly appreciate you tuning in. I'm sure you took something away from the session today. And Varun, thanks for setting this up.
Perfect. Thank you, Courtney. It was a pleasure to educate the realtors in terms of the mindset with Rob this morning. I think we all need it. I think everyone's need the push and the motivation and the positiveness. And thank you, Rob, for doing that. And thank you, Co, for sponsoring the webinar. Also showing our realtor partners how you can maximize their sales or look for the revenue stream during this tough market through your technology. And thank you for JF for joining us from Ottawa. This means a lot to us. And thank you, John, for putting all this together and working with me over the last couple of months organizing this. And
Yeah,
Courtney,
thanks, John, for putting up with Varan over the last few months.
Yeah, I was sleepless since 3 a.m. to make sure everything goes through, make sure no technology issues. And thank you, Joe, Chris, to make this on timely manner. And we are right on time, and that's very important for the audience. And Courtney, finally, are you going to be on the Fides payroll?
That's the question. Please, everybody, reach out to Varan, ask him when Courtney is going to be on the Fides payroll. I would appreciate that. Thank you.
Perfect. Thank you, everyone.